Max, you've been constructive for most of this year. You've been right to be for most of this year. Do you think it's a repeat of that for next year as well?
Yeah, good morning. I think so. I think it's pretty unlikely, if not virtually impossible, that big asset managers or the banks are really changing their outlooks dramatically, right? Let's bear in mind, 12 months ago, the overwhelming sense was we're going to get a recession in the first half of this year in the US, right? China's going to do better, Europe's going to do better, and then obviously it went the other way around. And if anything, we've seen signs of overheating in the US. But what's not changed is sort of cautious near-term outlooks. What's not changed is that people are still rolling sort of their recession forecasts 3 to 6 months forward. If you look at earnings forecasts, for example, look at consensus earnings forecasts. S&P earnings are expected to drop by almost $3 from Q3 down to Q4 currently, right? And then by Q1, in the first quarter next year, consensus is still saying we're not going to be even where we were 6 months ago. So that's how low earnings forecasts are. If you look at GDP forecasts, it's the same. It's round about zero for the next couple of quarters. So we're still faced with this pretty bearish, pretty pessimistic setup, which continues to allow pretty positive surprises. And that's good for risk assets.
Max, you're right, the Goldilocks is back. I get that. But what I love here is you've been right about this market. We've got outlooks coming up. Ed Yardeni shifts the playing field for the optimists like you today. Up 22% by the end of next year, SPX 5,400. Can you give that scope and scale to a bull market?
Yeah, I don't think it's unthinkable because when we look at, let's say, the next sort of 6 to 9 months, again, we've got very low near-term earnings forecasts, very low GDP forecasts, and we're probably going to get, core PC inflation below 3% by the second quarter of next year, right? So it's not miles away. It's not like we're talking about, sometime in 2025. We're talking about in 1 or 2 or 1.5 quarters. And suddenly, perhaps, real rates, the real federal funds rate, is then going to be way, way, way too restrictive. And then the market and the Fed can start talking about rate cuts in earnest. And then, perhaps the curve disinverts. And on the back of that, you're actually going to continue seeing a pretty Goldilocks-y environment, right? It's still going to be an environment, I think that's pretty much akin to what we had for most of this year, apart from the scare in September and October. So, this is still an environment where I want to be long consumer discretionary, where I want to be long tech stocks, where I want to be long the US in particular.